Hi, I'm Steven, and welcome to Business Progression. On this video, we will talk about market capitalization. First things first, what is market capitalization? Put simply, it is the value of a company as valued by the stock market. To find a company's market capitalization, you multiply its share price by the number of shares the company has outstanding. Pretty simple. Let's look at an example. Let's say you have a bread company that has 1,000 shares outstanding. The price of these shares will fluctuate for a variety of reasons, as does any share on the stock market. But let's say that the current price of one of these shares is $35. So 35 times 1,000 equals 35,000. Therefore, the current market capitalization of this bread company, or market cap for short, is $35,000. Let's do another example. Say you have a candy factory that has 10,000 shares outstanding. The current price for one of these shares is $65. So if you multiply $65 by 10,000 shares, you end up with a market cap of $650,000. Based on companies' market capitalizations, we can group them into different categories. While there are certainly other categories people use, the three main categories are small cap, medium cap, and large cap. Small cap refers to companies whose market capitalization is between $250 million and $2 billion. Medium cap refers to those between $2 billion and $10 billion. Large cap refers to those of $10 billion and more. But why does this matter? Well, it allows us to categorize companies according to their size. Small cap companies are obviously smaller companies, medium cap are medium-sized, and large cap are even bigger. Each of these categorizations helps refer to certain general traits of the company. Small cap companies can have large swings in their value. They could make you a lot of money, or they could lose you a lot of money. They are generally riskier to invest in, but can have big payoffs. Medium caps are in a more moderate place with still good potential for swings in value, but they are more stable than a small cap company. Meanwhile, large cap companies are usually seen as being the safest option, meaning that they will probably have lower swings in value, so you will probably not have as big of gains, but you won't have big losses either. Additionally, they have a higher likelihood of paying out high dividends because they are making tons of money and don't necessarily have rapid growth in front of them. Of course, it is important to note that these are generalizations. Massive companies can certainly fail or fall, such as Blockbuster, Kodak, Lehman Brothers, etc., and small companies may not be very volatile. That said, there is another reason why this matters. Market capitalization helps to give a general idea of the value of a company. While it certainly is not the best method for valuing a company precisely, it is a quick, easy, and fast method. Let's look at some real-world examples of market capitalization. As I mentioned previously, market capitalization numbers frequently change due to the price fluctuations in the stock market. Therefore, it is important to note that these numbers are from December 13th of 2025. For small cap companies, we have Yelp, Under Armour, and Fresh Del Monte Produce, all with a market cap around $1.8 billion. We also have Shutterstock with $667 million, and Build-A-Bear Workshop with $692 million. Under medium cap companies, we have American Airlines at $9.8 billion, Lyft at about $8 billion, Dropbox at $7 billion, Wingstop at $6 billion, and Vail Resorts at $5.7 billion. Then some examples of large cap companies are Apple at $4 trillion, Alphabet at $3.7 trillion, Walmart at $930 billion, Intel at $180 billion, and General Motors at $75 billion. Now you might be thinking, are you saying that if I spent $692 million I could control Build-A-Bear Workshop? Because of course we all have $692 million just lying around. But back to the general question, if you bought every share of a company, would you own it? Say there is a company where the share price is $10 and there are 10,000 shares. So if you spent $100,000, you could buy every share and therefore the company. Theoretically, this is true. You could gain control of the company if you bought every single share, and the market cap would be the price of it. Unfortunately, this idea only works in theory. There are a lot of nuances to this. For instance, you don't need to purchase every share in order to become a major shareholder that has a lot, if not all, control. Second, not all shares are for sale. Third, even if every share was for sale, As you purchased more, the price would go up due to supply and demand. There is a calculation called enterprise value that I won't go into now, but it is a better and more in-depth way of valuing a company. That said, market capitalization certainly is helpful and has its place. So to summarize it all again, market capitalization is the value of a company as valued by the stock market, and it is calculated by multiplying the share price by the number of shares outstanding. Thanks for watching. Hope you have a great day.